Were you worried on Monday and Tuesday, David? Did you think it was getting a little dicey? We're going to have a rerun of last December? It's still dicey?
It's still dicey.
Trade
There's a whole
is still
bunch
dicey.
of things.
Yeah, what else?
Well, look, even as I was just listening to Brian talking about the OPEC meeting, my attitude is that OPEC and the Saudis are trying to pull a Donald Trump effect. They're getting closer and closer to a tremendous, huge production cuts deal. But we'll be waiting for a long time before there's real production cuts out of oil, and that glut in oil will continue. But the other three things that are keeping things dicey, the economy is still slowing. It's not accelerating. It's still slowing. Maybe the pace of slowing is slowing down, but it's still slowing.
I think there's a huge disconnect between that and stock prices then.
Yeah, I know, because everybody.
So you do?
Everybody thinks there's the balance in growth and earnings is about to be here. One other thing on trade.
So you must, but just get back to that. So you're saying we're way out over our skis in the stock market?
The stock market's 5% overvalued, but big deal.
Only 5%.
Only 5%. We'll catch up. There'll be a dip, and we'll buy it.
You didn't even hesitate to tell me.
But,
is it 5.1% overvalued or 4.9? Or
5%, maybe slightly less. But it's about that much undervalued, and that's giving full credit to these interest rates.
This guy may know nothing, but never in doubt, right?
I'm not done. We're not getting a trade deal on December 15th.
Okay.
I think it's more likely the tariffs go up, albeit there'll be more exemptions.
We're going to let Larry tell you. He's not here just to look pretty.
So let me just... Nobody gets paid for just looking at what the data are saying now. We can all look at it, right? What you got to do is look through it and say, what's coming down the road? You're right. I mean, the numbers still are weak, but which is the sector that's really dragged everything down? It's manufacturing. You take an average of all the PMIs around the world, they're over 50 now, okay? Not in the U.S. because we had the GM strike. The second thing is, if you look at production, it's gone down a lot more than demand. So what's happening right now, and you're going to get a weak fourth quarter. Why? Because inventories are going to go down. That bodes well for the future. So the manufacturing recession is bottoming. Now, maybe, I'm assuming, like I think we all are, that trade doesn't get a lot worse here. We're moving into a period where things kind of stabilize as a truce with China and so forth. But things are getting better. And there's two, and so we're actually in a position now where all this weakness actually is going to extend the expansion. And there's two reasons. One, we got a lot of easing, more than people realize. It's not just the Fed, which we all know about, although a lot of countries peg to the dollar still. And so tons of central banks have eased. Remember in the financial crisis, we thought QE was just a financial crisis. We've got the Bank of Japan, the ECB, and even the Fed expanding their balance sheets again. Japan just announced a fiscal stimulus package for next year. China has a fiscal stimulus. Both parties in the UK, whoever wins, has a plan for pretty significant fiscal stimulus.
Stimulus is needed.
Okay? That's number one. The second thing right, Germany's another one. That's less obvious is what's caused the last two recessions. Really, it's not been inflation. It's not been tightening. It's that long periods of very low interest rates have caused leverage speculation. We've gotten asset bubbles. We've had a pullback. I don't know if there was just an article in the Wall Street Journal the other day. Buyout activity is down 25%. Leverage loans have fallen dramatically. So if you look at the whole world and looking for signs of excess, it was really leverage loans, CLOs that looked overextended. Those are way back down. That encourages me. In other words, what I would say is we've gotten into the pause here that's actually refreshes. Yeah. But Larry, you've got policy stimulus, you got a pullback in leverage, and you've set the stage. I'm not seeing a big boom here. I'm not saying we're going to have another big boom, but we already set the record for longest expansion. It's going to keep going here for a while. Very hard for me to see a downturn in the next 6 to 9 months. And that's good for stocks.
Enjoy the crawl.
Yeah.
The economy
I don't think it's going to boom.
But you're also describing the old playbook, which is that after a slowdown, you get a big bounce. But this is the third slowdown.
I'm not saying it's big.
It's going to be a very, very slight bounce.
Yeah. David, I want to know how you come up with this 5%, because I'm looking at a 17 and change PE.
On forecasts that are too high.
On the 10-year, 1.85% in a healthy economy. I think you could argue it's 5% undervalued.
So I'm using an 18.5 to 19 PE on the earnings we're expecting for next year, which is 4% earnings.
Even so, it's a 5-6%
Exclude
yield.
the financial sector, and it's below a 5% real yield. Now, but here's the thing, though. Here's the next chapter.
We got to wrap. You can see it says 59.
You'll get a better opportunity. You'll get a better opportunity.